Diversification right now, it doesn't seem very apparent, but to the rest of the world anyway, but we have definitely rotating out of Mag 7 into the boring defensive plays that are doing extremely well. The XLU, XLP, XLV, whatever it takes. This is basically my interpretation of the Powell pivot. As soon as he talked right here, we will do everything we can to support a strong labor market as we make further progress toward price stability. All I heard was whatever it takes. That's it.
This short clip is presented by Club. Club provides access to Samantha LaDuc and her team of professional macro and micro traders, analysts, and educators. Club is ideal for active traders, investors, and institutions who want Samantha's best-of-breed market timing calls across all asset classes and timeframes like chase, swing, and trend. Get the trade before it happens. Sign up to Club now and get full access to daily live trading room with Samantha LaDuc, Slack trading desk with detailed analysis and trades, custom trade support when you need it, and much more. For more information, visit www.LaDucTrading.com/club.
And I mentioned that live on Friday morning. Very much, reminiscent of the Draghi speech from July 2012, when ECB president said he had to say this in order to turn the European sovereign debt crisis around. And by the way, 2013 started a massive QE on the US side as well. So that helped the European sovereign debt crisis. But in any case, that's what I heard when I heard Powell pivot. And it is a pivot, and it was dovish across the board. To me, that this was a pivot, and that's very important because we got a double pivot. It's not just the end of a rate hiking regime, it's the start, and it's also the rate pausing regime, right? So they already had intonated in July of last year they were going to pause, and then they announced it November 1st of last year. So carry traders can really just press because they have a very clear path forward. Well, that path has now splintered. So not only have they confirmed they're not going to be hiking, there's no language around hiking at all, and they have also announced they are stopping the pause and going to cut. So now that's very tough for carry traders to kind of hitch their wagon to a monetary path because it has ended. So once it's announced, they must unwind. We already saw some of that unwinding occur in August, right? It got a little bit too out of control, and then they had to really suppress the dollar to help support the yen carry trade. But it is not over. No way, Jose. Neither is the basis trade that is yet to unwind. And I still think we're going to have more ahead, but we're going to also have to get through NVIDIA earnings and monthly OPEX and the month end, the quarter end, the JP Morgan collar, which is, a little bit of a thing. And then most importantly, elections. So it's not a wonder at all, to me anyway, that the Fed was talking normalization, right? They're not saying anything's wrong, but they're smelling labor stress is small, and they need to be very mindful of that. And that is why I firmly believe they're pushing this agenda of we're going to have gradual rate cuts, right? Why? Because that will help gradual unwind of some of these carry trades. You don't want them fast and furious like we had from Friday the 2nd into August 5th. So let's see how they do to land this plane, but that's exactly what they're doing. They're doing a pivot to help ease the normalization path and unwind. Let's see how they do, since I firmly believe they want to keep it stuck together until November 5th. In the meantime, Powell eviscerated the higher for longer. And this was something I smelled back in March and then really got excited about, basically going, I can't believe it, but I actually think, and I wrote this in April and again in May, I really think yields are going lower, not higher. So let's see what happens at 3.8. That's been my line in the sand. It's very strong support. If we stay here, that's beneficial. We can still grind higher. As I said, we break 3.8% on a solid break, not these wimpy little test. No. A solid break. Then we're going to have more gnashing of teeth in the equities market. But for right now, it's holding. So the big deal, though, I think, is Powell he wiped them clean. We still have inflationary fiscal spending, but they also are doing Fed balance sheet tightening. I'm going to write about that a little bit more on mortgages and what's happening with their runoff into 2025. So I've got some kind of interesting data. And in the meantime, in the in-between time, we still have structural inflation. I just think it's meeting monetary deflation. So some of these are kind of canceling each other out. This is my baseline bet that I talked about, that I see anyway: falling credit demand, rising unemployment, earnings as good as it gets, and the narrative turning from inflation to deflation. This is what I talked about 2 months ago. And so this is what I see playing out. So I'm not surprised that we have this pivot announced at Jackson Hole for a rate cut in September. And this durable goods order that we got this morning, which was very strong, is, in my opinion, pulling forward orders because of Canadian rail strikes and potential Trump tariffs, et cetera. Anyway, this is another thing that struck me, and Craig and I talked a little bit about this in the Macro Edge webinar that we did Friday afternoon. The Fed is data dependent, and every time the Fed does this, oh yeah, now we're data dependent, instead of the path is very, very orchestrated, right? We're either going to be in a hiking path or a pause path, right? Well, now being data dependent means, what are they data dependent on? PCE is not such a worry anymore. They are clearly focused on labor, not inflation this time. So that means they're worried about jobs and wages, not inflation this time. Means that carry trades will be worried about jobs and wages, not so much inflation. In fact, that is a bigger worry, that we don't have inflation as strong, because that's what they were banking on. So I believe this continued theme of falling credit demand, rising unemployment, earnings as good as it gets, and the narrative turning from inflation to deflation is going to be where I obsess. But the market will also be very focused on what matters most for this data dependent theme, and that's going to be the health and direction of private payrolls. And I believe this data revision that we got 2 weeks ago now, 818,000 jobs revised, et cetera, et cetera. This is going to be focus here. This is going to be how are we really doing in the labor markets? Fed is worried about it a little bit, enough to pivot. And we still have crowding out big time of government spending. And that basically means they're inflating wages through their hiring and through everybody gets 5% pay raise at the government kind of thing. And then the private industry has to match that, and the laws that are also passed. But right now, that's where I am focused for sure. Wage trends, because they are predictive of recession. They are also very predictive of consumer spending, and that makes up 70% of GDP, so it matters. So this is where I kind of parsed out. Friday was bullish, the market. We're still grinding higher. It's a pivot, but we absolutely are going to have pushback from the macro managers. I know it's not going to distract me. I still see more narrative focused on yields crashing lower, not higher. I'm stuck on that until I have reason to believe it's going to reverse, and I don't see it right now. Maybe after the election, maybe next year, but right now I don't see it at all. So you know this. I've been on this. What if yields crash down, not up? I've been very focused. Even June, I'm like, but I'm worried about global credit demand. It's starting to fall because the Fed was too high and higher for longer, which creates this kind of economic necessity of cutting. So now we get the whole globe now, except for Bank of Japan. They're a freak of nature. I just don't think that's going to stick. I don't think their 25 basis point hike is going to stick, because the carry trade unwind will just be triggered again. And that creates all kinds of disturbance in the force. So this is it. Global leverage unwind. Big picture is still in play. We're probably halfway, not even. We're kind of halfway through it. We don't see the demand falling yet so much. We do see jobs starting to be a worry, not just at the Fed, but also unemployment rate, et cetera, et cetera. We have not seen oil price fall, at least through my key trigger. We have not seen stocks trend reverse lower. I think that's going to happen after the election. As I mentioned in my semi-review big picture, I think we've got 2 more months of sideways, right? And then once stocks fall, wage growth falls, Fed cuts aggressively, we have recession. So it could be to 2025, a tail end, but for right now, it depends on the rate of speed, the rate of change, I should say. And right now, we're only maybe halfway through some of this stuff under the surface, but mainstream media isn't picking up on any of it. Everyone is very, very convinced that we have no recession risk at all for 2025. And this is the first time since June that I started worrying about recession risk in 2025. So anyway, I think that's it. Policy intervention and QE have a diminishing rate of return. especially, and this is why I have a big change in my tune since March, April, May, June, right? And I'm collecting this data to get more and more convinced of it, because falling inflation triggers carry trade unwinds. This is my whole theme, which, by the way, are triggered by central banks unable to inflate debt away, which is reason the funds can stay short notes and bonds in the first place, and oil, and long big tech. So if this becomes less of a thing, in other words, their whole macro reason is starting to evaporate, it will trigger more reason for the unwind. And that's basically it. I see that when the 10-year gets and stays below, first it was 4.2%, remember that? Then it was 4%. Now it's 3.8%. Carry trade can unwind again. Literally warned of that in early July. It really happened. So now I'm looking for the next trigger. When the 10-year gets and stays below 3.8% and crude oil gets and stays below 70, carry trades can unwind in a bigger way. And then when the 10-year gets and stays below 3.8% and crude gets and stays below $70 and jobless claims get and stay above 267, carry trades will start to price in a recession, because they're going to start to force one. All coming back up here, because that's when demand really starts falling, jobs fall, oil price, stocks, wage growth, Fed cuts aggressively, recession. So this is what I've been thinking about. This is what I've been working on literally since March, warned in April, got into it May, doubled down in June, and nothing has changed. If anything, this has just gotten further supported as the 10-year has fallen. Remember, I had 4.2%, and then I moved it down to 4%, and now I'm 3.8 is major support. This is why I'm really focused on it. And why I think NVIDIA can delight, and it's still going to be a sold to you. I think it's definitely going to be a sold to you for the next 2 months. And that's all there is to say. I think after that, we're going to have a market correction on global leverage unwinding, and it will impact liquidity. It'll impact credit spreads, the wealth effect, government tax receipts, company margins, employment, yada, yada, yada. So that's it. Just as markets are pricing in a Fed easing schedule because inflation is under control with little fear of recession or deflation, is exactly when I think we need to guard against it.
Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.